Hi guys, this is Aditya Vora here. Hope you guys are doing good. In today's video, I am going to talk about a very volatile sector. Now, to start with, I am sure you must have read about the Chinese economy reopening and the Chinese government abandoning their zero COVID policy. Imagine a major part of calendar year 2022 up till October where China followed a strict COVID policy and demand as well as supply was muted. However, as we approach the Chinese New Year in February, where millions of Chinese travel to their hometowns and are on vacation, travel and shopping dominate the country during the end of January and February. Basically, to put it in simple words, it is the Diwali of Chinese people in February. I am sure you don't need me to tell you that China is the biggest producer as well as consumer of almost everything. Right from steel to aluminium, copper, rubber to rare earth metals, China accounts for anywhere between 40 to 80% of share in global metals production as well as consumption. The reason why the metal sector underperformed in 2022 was on account of muted demand from China due to the lockdowns along with moderation in global demand. So if China is reopening and a lot of global recession fears are there in the price, why shouldn't we play the metal sector at least for the short term? Also, a lot of central banks are already more than halfway in raising rates and could stop increasing rates as soon as economies enter recession. So I started to look at the steel sector, but on seeing the price performance of stocks, I wasn't comfortable at these levels. I mean, look at JSW Steel or Tata Steel, most of the steel stocks are near their 52-week high. Basically, they have run up over the past 2 to 3 months in anticipation of China reopening. I don't deny the fact that they could go higher, but why not focus on sectors where there is a greater margin of safety? In that case, I started looking at a proxy to steel sector which also had an element of structural tailwind to it. I am talking about the graphite electrode sector, and the company which I am going to talk about is HEG. Before I talk to you about the graphite electrode sector, let me give you a brief on where this product is used and why it is dependent on the steel sector. So to start with, steel is produced either in an electric arc furnace or a blast furnace. If you look at the current steel production process, about 26% of steel is made through an electric arc furnace and the remaining 74% is highly polluting blast furnace. From a geographical perspective, about 70% of steel is made through electric arc furnace in USA and 55% in India. The European Union has about a 42% share of steel production coming from electric arc furnace, while China, the largest steel producer, which accounts for half of the global steel production, barely has 10% coming from an electric arc furnace process. So the question is, why is the world shifting to electric arc furnace? Well, A, relatively lower production cost and capex requirement. You know, the average cost per ton to construct a blast furnace is about $1,100, while the average cost per ton to make an electric arc furnace is about $300. That's huge reduction in capital cost. Secondly, the operating costs are at least 10 to 15% lower in an electric arc furnace. And lastly, the most important point, electric arc furnace generates 70% lesser carbon emissions as compared to a blast furnace. If you look at graphite electrodes are consumed in an electric arc furnace. To give you more details, an graphite electrode typically lasts for 22 to 30 batches, or let's say 10 hours, and the demand is driven by the production of steel through the electric arc furnace method. So technically, more the number of hours the electric furnace is used, more the number of graphite electrodes required. In short, it is directly related to steel production. Let us look at the graphite electrode industry in detail. There are 5 major players ex of China which account for 75% of the world's production, with Indian companies like Graphite and HEG accounting for 14% production capacity each. Being a capital and a technology intensive sector, the barriers to entry are extremely high. Now that the basics are sorted, let me give you a rationale and trigger why this sector can re-rate and why HEG is better than graphite in my view. The first trigger is the shift to electric arc furnace from blast furnace. Let me give you some numbers. United States of America, where 30% of steel production still happens via the blast furnace route, has decided to replace it with electric arc furnace. A total of 20 to 25 million tons of new capacities are likely to come up over the next 2 to 3 years, of which 6.5 million tons of capex is expected to start over the next 1 month, another 11.5 million tons in 2024 and the remaining in 2025. Besides this, even Europe plans to replace about 16 million tons starting from 2023. China, where electric arc furnace accounts for only 10 to 12% of steel production, is expected to take it to 20% over the next few years. This is going to be a very big trigger for the graphite industry. I am not even betting on increase in steel production going forward over the next 1 year. I am just saying this incremental demand over the next 2-3 years is likely to come from the replacement demand. Just imagine the growth which can come. And trust me, with environmental concerns, this is likely to happen sooner than later. Also, the cost of capex is 30 to 40% as compared to a blast furnace. Now my second point is a very short-term trigger over the next 6 to 9 months. Graftech, the largest manufacturer of graphite electrodes, recently closed their Mexico plant, which accounted for 30% of the company's production and 10% of world production ex of China due to some issues. Now when a graphite electrode which is used for 8 to 10 hours in the process needs to be replaced, you require a pin to add another electrode. The pin basically is just 4% of the weight and is sold with a pair of electrodes. Normally, large companies who have more than one location for producing electrodes, they have this tendency of concentrating their pin production at one place and then they air freight the pins to the other locations to sell electrodes and pins together. In Graftech's case, unfortunately, the Mexico location where all its pins were produced for dispatch to other plant is shut for 2 months and is expected to be shut for another 6 months maybe. Going forward, as the pin inventory keeps coming down in the Mexico plant, it will start to affect the entire graphite electrode production for the company. This is likely to benefit the 4 major players in the industry. So friends, these were the structural industry tailwinds which I mentioned above. Now let us shift our focus to HEG. Let me get straight to the point and talk about the rationale for investing in HEG and why it is preferred over Graphite India, the other player in my view. So exports account for roughly 70% of revenues for HEG. Now, while Europe is a problem due to rising cost, the share of exports to Europe from HEG is only 8 to 10% as compared to its competitor Graphite India, which has a subsidiary in Germany and had to shut operations as rising costs made it economically unviable. Also, if you see, USA and Middle East account for 20% and 27% of total exports for HEG. Massive capex is likely to be seen in these countries as they shift to electric arc furnaces. Secondly, if you look at HEG, the company has undertaken 20,000 ton capacity expansion, which takes its capacity to 1 lakh tons of graphite electrodes. This technically makes it the largest player in India, surpassing its Indian competitor Graphite India. Now, here is a big trigger for HEG. The company is entering into manufacturing of graphite anodes for lithium-ion cells through incorporation of a subsidiary company. The plant would be made in two phases, spending rupees 1000 crore in phase 1 over the next 3 years and another 1000 crore in the second phase post commissioning of the first phase in FY25. To put it in simple terms, on a conservative basis, the demand for graphite anode annually would be roughly 50,000 tons in India by 2025, which would mean 10 lakh electric vehicle cars or 1 lakh buses. This phase 1 will give HEG a capacity of 10,000 tons out of the conservative 50,000 tons of demand in FY25. This means that from end of FY25, the company at full capacity could generate an incremental revenue of 1000 crores by sale of anodes for lithium-ion cells. Also, from the raw material front, the raw material is needle coke, which is the same raw material for graphite electrodes which the company is making currently. All this incremental revenue will give a higher realization along with a higher margin. To end this, let me also talk about the valuations and the debt levels of the company. The valuations are relatively cheap as the company is trading at a book value. This means that the price to book value is 1 time. Also, if you look at from the price to earnings multiple, it is barely 7 to 8 times, and mind you, the steel industry declined in FY22 and is expected to be under pressure over the next 2 quarters at least. HEG has a cash balance of 935 crores as of September 2022 and a net cash position of 985 crores if you include investments. Such companies should be looked at during such turbulent times and low valuations. So friends, while I am bullish on the metal sector as China reopens and recession effect across the globe wears out, playing proxies like HEG and graphite in the electrode sector, which have a structural tailwind apart from other factors, is a better way in my opinion. While 2023 is likely to be a difficult year in terms of strong growth in steel demand, the important point is to look beyond the first half of 2023 as markets discount things much well in advance and companies like HEG have a net cash balance in their books and are available at book value. I don't think so they should be missed. So friends, thank you for watching my video and do let me know in the comment section.